Greetings to you all accountants all over the world. This is another presentation that I'm making for you. We want to, I think you can actually see my number. If you've got any questions, contact me and discuss. My objective is to make you understand some of the concepts that are difficult to understand when you're doing your self-study, especially at this time of COVID. That's my number. That's Jeffrey Masechengo presenting. In the lesson objective today, we need to be in a position to draft what we call the company accounts income statement, the statement of changes in equity, and then the statement of financial position. So that's what we are going to do today. Income statement of a company, you put your heading, then you are supposed to indicate, as usual, you're supposed to indicate the revenue for the period. You can write sales or the revenue for the period. I think that the actual term is revenue for the period. So the revenue for the period. Then if there are sales returns, you deduct sales returns. Then cost of sales, that's the next heading. Cost of sales is a component of opening inventory. You add your purchases, add your carriage inwards, then you less your closing stock, right? We used to call it closing stock, but let's just call it closing inventory, right? We can call it closing what? Inventory. This is the actual term that we are supposed to use. So we are going to deduct this. We're supposed to deduct this. We deduct this from this total. So we add 46 plus 630,000. We get a total of 676,000. Then you deduct the closing stock. You push the figure to the last column. Then what you are going to do from this point, you're expected to, from this point, you're expected then to deduct it from what? From your turnover. Then you get your what? Your gross profit. Then you less what do we call them? The expenses. So the expenses in a company setup, they are categorized into groups. Let's say 3 groups, right? We've got expenses that are related to distribution, expenses that are related to administration of the admin expenses. Then we've got what we call the finance costs. All these are deducted. So you are supposed to be in a position to distribute, to group your expenses into distribution, admin, then into finance costs. Okay. Then under distribution, we've got expenses. Let's say we've got sales staff wages. They are under distribution. We've got delivery van depreciation, delivery expenses. And then you are supposed to add the 2, right? You add the 3, then you get your total. You push the total to the last column, let's say. So you can just do this part as you're working somewhere. Then you transfer this as your final figure, 132,000. Okay. Then after that, you are supposed to calculate also your admin expenses. You do your calculation. If you add these ones, then you will find that the total is $104,000. Then that's so you can actually do the working. This one, it can be part of your working. Then you just transfer this figure. You do your working, you transfer this figure. Under administration expense, we talk of admin wages, office expenses, depreciation for accounting machine, depreciation of office assets, and we've got advertising. Okay. We can have these expenses. Then when we add this one, so we've got this one and this one, we are deducting this one. Then we move on to finance cost. When we are talking of finance cost, we are talking of debenture interest. Debenture, these are loans that are given to companies. So when these companies, they are given loans, they are mandated to pay interest to companies. So when they're paying interest on debentures, this is an expense. We charge this one. You must be very careful. You must follow our next presentation on how to compute debenture interest. The debenture interest that is recorded in the income statement is according to the accrual concept. So we record the total interest payable in that year, not the paid one. I think you need to follow the next presentation. Then interest on overdraft, it's another finance cost. Then you add your finance cost, 12,000 plus 0, then you get 12,000. You put this one in the last column. So what we are particularly interested of is these figures. Okay. Then when you're done, you get your operating profit. This is a deduction of all these figures. I think you can actually follow that if you deduct Okay, that if you deduct, you can actually see that if you deduct from your gross profit, then you deduct this one, you get your operating profit, then operating profit, you deduct your tax for the period, then you get the net profit for the period. So let me just show you the statement as it would appear in the, when you are done with it. So I think you can actually copy this one, you pause the video and try to follow our presentation, or let me just minimize it so that it can appear on one screen, so that you can actually see it on one screen. But it's difficult for it to fit, okay? But I think you can actually follow from this, that this is how you do your income statement. So it's actually very easy. I think you can actually do that. Okay, let's move on. When you're done with the income statement, you are supposed to move on to what we call a statement of changes in equity. And when we are talking of equity of the company, we are talking of the interest of shareholders in the company. So our equity is a component of ordinary shares plus irredeemable preference. Okay, irredeemable what? Preference shares. Okay, if we have got preference shares that are not to be redeemed, okay, to redeem preference shares, it's a concept of buying back the shares. So we're saying if they're irredeemable preference shares, you are supposed to include it under equity. So equity is a component of ordinary share capital, ordinary shares plus ordinary share capital plus irredeemable preference shares. Please note that irredeemable preference shares, not redeemable. Then it's a component of share capital. This is the excess of a nominal value. Then the revaluation reserve, then the retained earning. So you can actually see if that this component is actually representing what? Our general, our revenue reserves, okay? Revenue reserves. So it's a component of capital reserves. These are our capital reserves, right? And this is our share capital plus our reserves, which is a component of capital reserves and revenue reserves. So then what do you do when you're doing this one? You start with the opening balance. Let's you take it from your trial balance. In this case, we've got 900,000. Share capital is nothing. There's a zero on this one. This is, remember, it's just a demonstration of the example of the presentation. Then a zero on this one. There's 7,000. Then general reserves. What you're supposed to do now is to add horizontally. You add these figures. You can actually see that the total is 957,000. This is the total horizontally. You are supposed also to add the figures again downwards. Then you get the total, you add the figures again downwards, you get the total, you add the figures downwards, then you get the total, you add the figures downwards, and that is that. So, but what do you start with? You start with your balance BD. Then if there is new issue of shares, if issue new shares, it will affect the ordinary shares column only, please. So in this case, we don't have any issue of ordinary shares. Let's say we have issued some shares and we have issued, let's say 1,000 shares. Okay, if we have issued 1,000 shares, we enter the 1,000 shares for this section. Then when we have issued the shares at a premium, let's issue at them at a premium of 500, you add it under the premium. Then you can actually see that the totals are adjusting automatically. That's how we do it. Okay, so let's say then, so we are done. It will not affect the revaluation reserve. It will not affect the retained earnings. It will not affect the general reserve. So you add the total. This is 1,500. You can actually see appearing on your last column. Then we have got our profit for the year. If we have made a profit for the year, it will not affect this column. It will not affect this column. It will not affect this column. But it will affect, let's say, the profit that we have made from our income statement. I think you can actually remember this figure. We got it from our income statement, the 98,000. Let me actually show you so that you get your 98,000 from this. Okay, your 98,000. You can actually see the 98,000. You get it from the income statement. Okay, you get it from the income statement. 98,000. You put it there. Then you are going to add with the balance BD plus 98,000. Then you continue, but let's add the horizontally. In this case, you get 98, then the total becomes 98. Then the directors of the company, these are stewards of the company, they are given the responsibility to plan for the company, so they can decide to transfer a certain amount to general reserve. They say transfer 50,000. If they say transfer 50,000 to general reserves, what do you do? What do you do in this case? They are saying transfer 50,000 general reserves. So we are going to say minus 50,000. It will reduce our retained earning minus 50,000. 50,000. You can actually see that we put minus 50,000. It will reduce. Remember, general reserves, they are created out of the retained earnings or out of debiting the profit and loss account, and we credit the reserve. So be careful, please take note that transfer to general reserves, it will reduce our retained earnings and it will increase our general reserves. Okay, then you can find that the net effect of this one, a minus and a plus, will give us a 0 on this one. So we are good to go. Then the directors also might also decide to pay dividends subject to approval by shareholders on the annual general meeting. If there is any dividend that is paid during the year, it reduces our retained earnings or profit for the period. Then we are supposed to put them under this column. Then it will appear as a negative in the last column. Okay. Then we have got gain. Let's say the asset was revalued by upwards by $200,000. So we are supposed to go under the asset revaluation column. Asset revaluation column. Then how much was it? The increase in revaluation, right? That's what you record. They say it's 200,000. Okay, this is 200,000. You can actually see that it will automatically update my last column because it's an Excel sheet which I have inserted some formulas. Then it will add this column. Then what I'm supposed to do, you add all the figures. In this case, you'll find that they'll give us the total. If you compare with the total on this side, you can actually see that the columns are tallying. Then you are done with your statement of changes in equity. Remember, this is a statement of changes in equity. Please take note. Preference dividends, preference shares are not entered in the statement of changes in equity unless we have got what we call irredeemable preference shares, shares that will never be bought back, or this is a permanent type of preference shares. So they fall under equity. We are done with this one. When you're done with the statement of changes of equity, you move on to what we call the statement of financial position. I think this is similar to the one that we have covered in sole trader in other accounts. You prepare you put your heading, you have got your asset column, the cost, the accumulated depreciation, the net book value. And remember how you do this one, you say the premises are worth this much, you deduct the depreciation, and you get the amount. So on this figure, I think there is need the asset, this asset was the revaluation, was revalued. So this is out of revaluation. You can actually see the difference, right? Revaluation, it was a revaluation because this asset was not depreciated, but increasing in value. So it is an appreciation, and we call it was revalued upwards. Then our motor vehicle, our cost 80,000, then our depreciation, you get our net book value. Then it's easy, you add the total on this column, you add the total on this column, add the total on this column. But what you're supposed to do, you're supposed to close in this section, you close this section, then you move on to our calendar assets. I think I've covered this one on our previous video. You can actually see this. Then on our assets, you start with our inventory, our receivables, the provision for credit loss, the prepayment, the cash at bank, cash in hand. Then you get your total assets. Total assets is very simple. You add this figure plus the total assets, then you get this one. Okay. Then you move on to the last heading, which we call equity and liability heading. This is a very simple heading. It's a matter of coming up with a statement of changes in equity. You can see that this figure is actually appearing in our statement of changes in equity. Our share capital, our share premium appearing again in our reserves, in our premium. Then our revaluation reserve, our general reserves, our retained earnings, right? You get the total, you sum, you get the total. This is a very simple column, the total that we have in our statement of changes in equity. So this column, this figure is in our statement of changes in equity. Then you move on to your non-current liabilities, our debenture, our mortgages. Then you add the total, transfer to the last column like that. Then you move on to our current assets. Okay, I think if I'm moving fast, you pause the video, try to listen to that. Then our current assets, our payables, our drafts, our owing and paid debentures, and so on. Then we are done with the format. So this is how you prepare the statement of changes in equity for a company. This is my presentation that I wanted to use. So I will be posting. Please subscribe to this channel. I'll be posting more videos on our YouTube channel. And just like say Jeff and accounting say Jeff, then you're good to go. I'm posting another video that is very critical. I'll post some assignments, I'll post some works that I'm expecting you to do. Please take note. But otherwise, I think we are done for the lesson. Remember, our objective today was to draft an income statement, statement of changes in equity, statement of financial position, and this is our statement of changes in equity. That way, you start with your revenue for the period, then get your gross profit, you put your expenses into group distribution expense, admin expense, finance cost, then deduct your tax, then you get your profit for the year. When we're done with this, we said we move on to the statement of changes in equity, where it has these headings, started balance BD, new issue of shares, which will affect the share capital and the share premium. Then the profit for the year will affect one column, our retained earnings. Then we move on to our general reserves. They'll affect the retained earnings. They'll increase also the general reserve. The dividends will affect the retained earnings as a deduction. Revaluation reserve will affect the revaluation column. Then we are done with this one. We move on to our statement of changes in equity, our statement of financial position. As usual, this is it. We are done the lesson. This is the stage of presenting. So we meet in our next presentation, but remember to subscribe for more videos, and that will be good for you. All the best in your exam.